Imagine receiving a frantic message from a friend, a link to a video with a thumbnail, screaming that the world's most powerful financial institution has just made a secret, explosive move in the silver market. The title promises a leaked memo, a hidden play that will change everything. Your heart rate spikes. This is it, the inside information you've been waiting for. You click, and for 20 minutes, you're swept up in a narrative of clandestine meetings and trillion-dollar maneuvers. But when the video ends, you're left with a pressing, unsettling question. What actually just happened? The truth about institutional movement in the silver market is far more revealing than any conspiratorial leak, and it tells a story not of a single explosive play, but of a profound glacial shift in how the world's largest pools of capital view the very foundation of our future. It is a story written not in secret memos, but in public filings, in the quiet logic of risk management, and in the undeniable physics of industrial necessity. To understand what is happening, we must first dismiss the ghost of the lone, all-powerful market manipulator. The narrative of a single entity like BlackRock or JP Morgan flipping sides with a secret memo is a compelling fairy tale for a complex world. In reality, these institutions are not monolithic gambling entities. They are vast, bureaucratic ecosystems managing trillions of dollars for pensions, endowments, sovereign nations, and individual retirees. Their moves are rarely about making an explosive directional bet on a single commodity's price. Instead, they are about balancing risk, gaining exposure to macroeconomic themes, and meeting the demands of their clients. When we see significant capital flow into a vehicle like the iShares Silver Trust, SLV, the largest silver-backed ETF in the world, we are not witnessing a speculative raid. We are witnessing the end result of 1,000 calculated decisions by fund managers, asset allocators, and financial advisors, all responding to the same set of powerful public signals. The first and most powerful of these signals is the undeniable reality of structural supply and demand. For decades, silver was primarily a story of investment and jewelry, with a side of photography. Today, that story has been rewritten by technology. Over 60% of annual silver demand is now industrial, and that percentage is climbing. This is not a speculative claim. It is hard data from the Silver Institute's annual survey. Every standard solar panel contains approximately 20 grams of silver paste, a material for which there is no commercially viable substitute that maintains the same efficiency and longevity. With global solar capacity installations smashing records year after year, a trend endorsed and projected by every major energy agency, from the IEA to the U.S. Department of Energy, this creates a voracious, predictable, and inelastic base of consumption. Simultaneously, silver is the essential conductive element in virtually every high-reliability electrical contact, from automotive electronics and 5G infrastructure to advanced aerospace systems. This industrial demand forms a physical floor for the market. For an institutional allocator building a portfolio for the next decade, this transforms silver from a purely speculative, volatile precious metal into a hybrid asset, a tangible input into the world's most urgent megatrends: decarbonization, digitalization, and electrification. The second signal is the evolving landscape of inflation and currency debasement. Since the 2008 financial crisis, and dramatically accelerated during the COVID-19 pandemic, central banks worldwide have engaged in unprecedented monetary expansion. This has left institutional portfolios drowning in financial assets: bonds, stocks, derivatives, all claims on future cash flows that can be eroded by inflation. There's a growing institutional hunger for real physical assets with limited supply. Gold has always been the primary beneficiary of this hunger. However, silver offers a compelling, leveraged alternative. It maintains that ancient monetary heritage, historically moving with gold, but it now carries the turbocharge of industrial utility. For a pension fund manager looking to hedge a multi-decade liability against both inflation and participate in the energy transition, allocating a small percentage to physical silver ETFs begins to look like a sophisticated form of insurance, not wild speculation. This is the real play that is often sensationalized. Not a secret squeeze, but a strategic reallocation into tangible assets within a world of digital abundance and monetary uncertainty. So how does this institutional intent actually translate into market action? The mechanism is crucial and often misunderstood. A massive institution like BlackRock does not call up a bullion dealer and order 10,000 bars to be stored in a private vault. Instead, they utilize and create financial vehicles that provide exposure. The iShares Silver Trust, SLV, is a perfect example. When an institution or its clients pour money into SLV, the Trust's authorized participants, large banks, use that cash to purchase physical silver bullion on the wholesale market and deliver it into the Trust's allocated vaults in London and New York. Each share issued represents a claim on a specific amount of that physical metal. Therefore, sustained net inflows into SLV, which hold over 15,000 tons of silver, represent a direct physical withdrawal of metal from the available market above ground. This is not paper manipulation. It is a conversion of financial capital into physical inventory. It is a quiet, persistent drain on liquidity. When multiple institutions and thousands of retail investors make the same decision simultaneously, the effect is a steady tightening of the physical market. Even if the paper price on the COMEX futures exchange, driven by short-term traders and algorithmic funds, remains disconnected and volatile. This brings us to the critical fault line in the silver market. The dichotomy between paper and physical. The daily price you see quoted is predominantly set in the futures market, where contracts representing millions of ounces are traded electronically by players who may never intend to take delivery. This paper market is highly sensitive to dollar strength, interest rate expectations, and macroeconomic sentiment. It can be dominated by short-term speculation. The physical market, however, obeys different laws of geology, mining costs, refinery capacity, and manufacturing deadlines. This disconnect creates the recurring conditions for what analysts call a physical squeeze. It is not a conspiracy, it is a structural vulnerability if industrial demand and investment demand continue to pull metal out of registered vaults to stick the portion of inventories available to settle futures contracts, while mine supply remains stagnant, which it has, as over 70% of silver is a difficult-to-expand byproduct of copper, zinc, and lead mining. The entire paper pricing mechanism risks a rupture. Institutions are not necessarily engineering this rupture, but by systematically accumulating physical exposure through ETFs and other means, they are inadvertently highlighting the fragility of the system. They are voting with their capital on a future where physical scarcity trumps paper promises. The 2021 social media-driven attempt to squeeze silver, often pointed to as a moment of revelation, was in fact a clarifying failure. It demonstrated the immense power of the paper futures market to absorb sudden, chaotic, speculative demand. However, in its aftermath, something more significant occurred. It introduced the concepts of registered inventory and physical delivery to a generation of investors and, importantly, to institutional analysts. Since that event, despite the price retreating, we have seen a notable trend. A steady migration of metal out of the exchange-approved vaults and into other forms of storage, including ETFs and private allocated holdings. This is the quiet, post-squeeze reality. The fireworks failed to ignite the price, but they illuminated the landscape, and the smart money began a more disciplined, long-term occupation of the physical ground. Therefore, the next time you see a headline screaming about a leaked memo or a secret flip, look past the drama. The real story is written in the quarterly 13F filings of asset managers, in the annual reports of mining companies discussing their struggle to increase production, and in the policy documents of governments mandating solar capacity. It is the story of capital, slowly and methodically, aligning itself with a material reality. Silver is no longer just the devil's metal or a relic of monetary history. In the eyes of the institution, it is becoming something more pragmatic and profound, a critical industrial component with a finite supply, sitting at the intersection of monetary devaluation and technological transformation. Their move is not a sudden flip, but a gradual, inexorable turn. They are not betting on a secret. They are preparing for a future that is already visible, building a bridge from the financial world of digits and derivatives to the physical world of conductivity, reflectivity, and scarcity. The play is not hidden. It is happening in plain sight. One ETF share, one solar panel, and one strategic allocation at a time. The memo isn't leaked. It's the entire script of our energy and technological transition, and the world's largest investors are finally starting to read their lines.